The way most people are trading Apple is fundamentally broken. If you are losing money on Apple, or if you feel like you're missing out on some great returns, maybe we can help fix that. My name's Alex. I've been trading for over 10 years, and I'm going to show you the kind of traps retail traders fall into when they're trading Apple. Let's start by pulling back the curtain. Apple isn't what it used to be. And take iPhone sales, Apple's pride and joy. Those drive over half of revenue. But last year, sales only grew 4%, and up to 90% of those sales were just upgrades for existing users. When you're not getting new customers, you're not typically getting new market share. In fact, in September, the iPhone 17 rollout lost them over $50 billion in market cap. So if products aren't driving growth, what is? Services. If Apple keeps expanding their ecosystem and collecting service fees and subscriptions, they're getting stable, compounding gains. And you know who really likes stability? Big institutional shareholders. They love predictable cash flows, strong margins, stock buybacks, and zero surprises. So what does that mean for you? Since Apple doesn't want to take big risks, long calls and puts usually aren't the way to go. If you're dealing with smaller volatile stocks like Rocket Lab or SMCI, you're going to see some massive 50% price swings. A long call or put makes sense. But here's why with Apple, you're using the wrong tool for the job. Let's say Apple is trading at $300. You're bullish, so you buy a 1-month call at $310 for a $10 premium, so $1,000 per contract. Because of that $10 premium, your break even is $320, not $310, not even $315, $320. Just for you not to lose money, you need a 7% jump by expiration, which is pretty rare. But hey, let's say Apple does move up after 2 weeks to 306. You were right on direction, but you're dealing with time decay. With each passing day, your option is bleeding money. In just 14 days, you lose $400. Fast forward to expiration day, and let's say Apple goes up again to 312. That's past 310, so you're in the money. But remember, you paid $10 in premium. All that time value is gone, decayed, and now your call is worth its raw intrinsic value. With something like a long call, you need a stock to go up way harder and faster than the market expects. So how do we get Apple's movements to work for us, not against us? Well, here's the trick. Don't ask, where do I think Apple will go? Ask, where do I know Apple won't go? What's the range of probability, the floor and the ceiling, that I can work inside? That way, we can use Apple's movement to our advantage, and I'll show you how to do just that. If you want to trade Apple like a pro, you have to think like an insurance company. Insurance companies hope you never need them. As long as you're paying a premium every month and you don't need to pay out, Jake from State Farm stacks up profits. They make money when nothing happens. We're doing the same thing with Apple. Instead of betting on Apple moonshotting or crashing, we're taking advantage of the stock's natural smaller movements and working inside a realistic safe zone. We have to use what's called a credit spread. A credit spread starts with opening up 2 positions at the same time. You sell a contract and collect a premium up front, but to help protect yourself from risk, you buy a second option further away from the stock price to act as your safety net. In every credit spread, you're always selling the more expensive option that's closer to the stock price and buying the cheaper option that's further away. But whether you're bullish or bearish on Apple, a credit spread is still designed to work in your favor. If you're bullish, you're hoping the stock price stays above your floor, so you use a bull put spread. You think Apple won't go any lower than $295, so you create the floor by selling a put at the $295 mark, and then you buy a cheaper put further down as your safety net. If Apple stays above that $295 floor, you profit. If it dips below the floor, you minimize your losses. If you're bearish and you want the stock to stay below the ceiling, you flip the script with a bear call spread. Sell a call at whatever strike price you think it won't break, say 315, then buy a second call at a higher price, like 320, to act as an insurance policy above your ceiling. As long as Apple stays below that 315 mark, you profit. If Apple breaks through the ceiling, the higher call caps your losses. But you're probably thinking, hey, how do I know where to put that floor or ceiling? Well, that's why I use a 30 delta rule. We're still acting like an insurance company, and that rule is our formula for setting up our deductible. Delta, put simply, is how much an option's price changes for every $1 move in the underlying stock. It sits on a scale from negative to positive 1. Call options have positive delta. Put options profit when the stock goes down, so they have negative delta. Now that you know the basics, here's how delta helps you set up a floor or a ceiling. So delta gives you a rough estimate of how likely that strike you chose will finish in the money, meaning the stock moved past your strike price and your option is gaining some value. A 30 delta option means there's a 30% chance the stock finishes in the money. That's why we call it the 30 delta rule. And plenty of traders choose 30 because you're getting a decent risk to reward ratio. 10 delta is safer, but the premium is almost nothing, and 50 delta gets you a higher premium, sure, but it lowers your chances of success over the long term. For a stock like Apple, 30 delta is what I consider that Goldilocks sweet spot. For a bull put spread, you want to sell that first put, the floor, at a negative 30 delta. Don't let the minus sign on the put side throw you off. It just means the stock and the option move in opposite directions, but the math and the probabilities work exactly the same. For a bear call spread, sell that first call, the ceiling, at a positive 30 delta. Let the math, the probabilities, take the guesswork out of it. Now here's where this strategy gets even better. Credit spreads thrive when implied volatility is high. So when volatility is up, it's harder for market makers to predict where a stock is going to go, so they charge higher premiums. But you know Apple is a relatively stable stock. It's probably not jumping 10% every time there's high volatility. By selling your calls or puts, you're collecting that credit with inflated premiums, and you're not sweating a big change happening in a single day or week. This is Apple, after all. Even if you know the math here, one misstep can ruin your advantage and tank your trade. So let's walk through exactly how to execute a credit spread on Apple. Now, I'm going to use a real setup using data from when Apple was priced at $300. Here are the 4 steps to make it all work. First step, let's say we're bullish, so we're going with a weekly bull put spread. On our broker app, we hit vertical, which is another way to say a spread, and we're going with a 292.50 to 290 spread. Why those strikes? Well, if you look at the options chain under puts, the strike with a 30 delta is that 292.50 floor. Theoretically, there's a 70% chance the stock stays above your floor and expires completely in your favor. So with a bull put spread, you're selling that 292.50 short put and buying that long put at 290 as a cushion protection against bigger losses in case the price actually does tank. 2. Calculate the spread's net credit. The spread width, the difference between that 292.50 floor and your 290 cushion, is $2.50 per share. Think of that second put like a financial airbag. If Apple does something uncharacteristic and crazy and crashes at 240, you're forced to buy it at 292.50. But you can also make some of that money back by selling it at 290 from that second put. Now remember, a credit spread is an insurance play, so like an insurance company, you're collecting a premium up front. How much is that premium? Well, you find your net credit by subtracting what you pay for protection from what you collect. You sell the 292.50 put and collect $2.10 per share. You buy the 290 put and you pay $1.50. So your net credit, the premium you collect up front, is 60 cents per share. 3. Find max loss and check the math. Now, let's talk about your worst case scenario. To find your max loss, just subtract that 60-cent net credit from that 250 spread width. That leaves you with an absolute max loss of $1.90 per share, or $190 a contract. If you're listening along and doing the math in your head, you might stop right there and say, wait, Alex, risking $190 just to make 60? Even with a 70% win rate, the expected value is negative $15. Well, I'll tell you, good catch. That's a trap where amateur traders get stuck. They treat those raw expiration numbers as gospel, but you're an insurance company. You aren't sitting around waiting for expiration day. So here's how you flip the script. First, remember, the market, it overprices risk. In the real world, a 30 delta option is going to win more than 70% of the time. The odds are already skewed in our favor, and the chart just won't tell you that. But more importantly, it all comes down to active management. If Apple actually drops and threatens your 292.50 floor, you don't just sit there and take the full 190 hit. A pro trader cuts their losses at around $90 in this case. If you want to get higher win rates, track the price action and pull the plug early when the math tells you to. When you use real-world probabilities and smart money management, your expected value should completely flip into the positive. But if you want a quick sanity check before you trade, use my 25% rule. If you multiply the total spread width by 25%, that gives you the minimum premium benchmark to see if the trade is worth the risk. Why 25%? Well, for a 30 delta trade, 25% is the sweet spot. If you collect anything less, you're risking too much to make a dollar. Anything more, and you're moving your floor way too close to the current stock price, which can destroy your win rate. So let's go back and check our trade. Multiplying that 250 width by 25% gives us a benchmark of 62.5 cents. Since our net credit is 60 cents, we're right in that safe zone. 4. Sell the vertical. Once you lock in that spread, you're not just sitting on your hands waiting for the clock to run out. The secret to a positive mathematical edge is this: close the spread at 50% of your max profit. If you sold it for 60 cents, you buy it back and exit the trade the moment it drops to 30 cents. It's not closing the trade too early. Remember when we were trading Apple with the long call? Time decay was eating us alive. But with the credit spread, since you sold that main 292.50 put to someone else, time decay is now working for you, not against you. You collected their cash up front, and you profit as that specific contract loses its value. So why not just wait it out, let it drop to zero, and keep the full 60 cents? Well, instead of time decay, credit spreads have a different kind of problem called gamma risk. Early in a trade, price movements are slow, predictable. But as you get right up to expiration day, the option gets hypersensitive. Gamma is like an amplifier. Suddenly, a tiny, routine $1 drop in Apple can cause massive, violent spikes in the value of the option you sold. One bad afternoon could turn a winning trade into a losing one. And we want no part of that. By stepping out early and buying the spread back at 30 cents, you're dodging 80% of that late-stage gamma risk and pocketing an easy win. And that's the rhythm you set. Wins that are small, highly probable, and quick. You take your profit, you eliminate the worst-case scenario, and you move on. Over time, those consistent wins build some serious wealth. Now you have the blueprint to try this out on Apple. But remember, Apple isn't the only stable giant out there. There are plenty of massive tech stocks where this credit spread strategy works. And in a market that's constantly obsessing over what's new and what's the next moonshot, there's a fortune you can make quietly betting on more of the same.